What is market making? When somebody wants to buy or sell cryptocurrencies, they need to go to an exchange where buyers and sellers meet. The price they pay depends on the supply and demand at that moment. This is translated to the bid, price to buy, and ask, price to sell. The difference between the bid and the ask is called the spread. If there are limited counterparties to trade with, it may not be possible to buy or sell, and that market is now considered illiquid. New exchanges, or newly listed coins that have just had their IEO or ICO, often lack liquidity and have a big spread. To guarantee liquidity, exchanges ask professionals to provide a bid-ask spread to the market continuously. In other words, these professionals make markets, hence why it's called market making. Market makers usually don't base their trading on market movements, but make a profit on the difference between the ask and the bid, the spread. A market maker normally places an order on the top of the order book and will try to sell it immediately. The profit they take is the spread minus transaction fees. The risk market makers have is that the markets drop so quickly that they're not able to sell the newly bought asset with a small profit. With Cryptohopper, it's possible to have different strategies for different market trends. With downtrend markets, there's a different strategy necessary than with the sideways or uptrend market. Cryptohopper is the first market-making bot that can automatically adjust your market maker based on the current market trend. Market makers often try to scan for markets with bigger spreads, so there's more profit to be made. Cryptohopper offers a clear overview of the markets and its spread, so you're always able to pick the right market for you. So now that you know what market making is, it's time to watch our other videos on market making where we explain how the basics like how to set it up, and we have a video where we cover every possible configuration setting. Happy hopping!